webinar. My name is Steve Boisvert. I am a tax manager at Gelman, Rosenberg Freedman. And I'd like to start off today's program with some quick housekeeping items and explain what participants need to do in order to earn CPE credit for today's webinar. If you have any technical questions or issues during the webinar, please use the chat function to speak with our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. Please note this webinar will be recorded and made available on our website following the event. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall the CPE words shared during the presentation in order to receive credit, and we'll try to make those very clear. If you have an active pop-up blocker, just take a moment to disable that so that you won't block the survey. Any technical questions about the survey can be addressed to Jennifer Disharoon. In addition to the webinar recording, presentation slides will be made available for download from our website. As the title of today's webinar implies, today's learning objective is to provide attendees with a better understanding of the impacts to personal income and business taxes under the new tax law. Two CPE credits are available to attendees of today's webinar. In front of you now is a quick look at today's agenda. During part one, we will focus on individual impacts associated with the new tax law. This will be for about the first hour. At 12 p.m., we're going to shift to part two of the business impacts and introduce Pat Ennis of Ennis Legacy Partners. Finally, if you're interested in information regarding tax-exempt organizations under the new tax law, please tune into part three on February 15th. This will be taught by Steve Kellen and Dick LaCastro, and they will be a great resource to you. The registration is now available through our website at grfcpa.com/resources/events. At this time, I want to introduce to you our instructors. Walter Dial is the director of our for-profit tax department, and my name is Stephen Boisvert. I'm a for-profit tax manager.
Thanks, Steve. Let me ask you a question. How old were you in October of 1986?
I was not born yet.
Wow. The reason I asked that question is because that was the last time we've had such comprehensive tax reform legislation. So is it safe to say that the Tax Reform Act of '86 did not have a major impact on your life?
Yeah, not that big an impact.
It's a little bit different story for me. So I was in my fourth year at GRF, and we were a very small firm when I first joined, only about six or eight people. So for the first few years, we were doing, you pretty much did everything. You did tax work, you did auditing. But by the fourth year, I was doing pretty much all taxes. You know, I like to think it was because Michael Gelman realized what a tax genius I was, but it very possibly may have been that I was just really bad at auditing. But either way, I got the task of going through the '86 Tax Act, helping explain it to our partners and staff, and then helping our clients strategize concerning it. So it was a pretty daunting task. If you think, obviously you weren't even born, but what happened back then was the tax brackets went from, it was either 12 or 15 brackets down to just 4. The top individual tax rate went from 50% down to 35%. They made dramatic changes to the alternative minimum tax, which resulted in millions of people getting impacted by that, including a lot of our clients. And probably the biggest and most complicated change was the introduction of passive loss rules, which really affected people who had invested in real estate or who were partners in limited partnerships and things like that. So it was a really daunting task, but it was also kind of exciting because whenever there's a big tax law change, you know, any type of change presents opportunities for us to help our clients, you know, minimize the bad consequences of change and also take advantage of any opportunities there are to reduce their taxes. So we're kind of in the same situation today. You know, we have this legislation. It's not as comprehensive change as the '86 tax was, but it still has some major implications and I think a lot of opportunities. So I probably shouldn't do this, and I haven't cleared it with our executive committee, but I'm going to do it anyway. I'll probably get in trouble, but they don't really like me anyway, so I'll just do it. I'm going to make a guarantee to you that at the end of this webinar, you will walk away with at least one strategy to save over $1,000 in taxes. And if you don't, we are going to refund 3 times the price you paid to attend this free webinar. Okay, let's go ahead and get started, Steve. Let's start by looking at the old tax rates. So these are the rates that are in effect, up through December 31st, 2017. So you see there's 7 brackets. The top tax rate is 39.6%. For a married couple, that kicks in at $470,701. For a single person, it kicks in at $418,401. So those are the old tax rates. Let's take a look at the new tax rates. So with the new tax rates, we still have 7 brackets, but you can see a few big changes. Probably the biggest one is the top rate is now 37%, and a married couple doesn't hit that until their income exceeds $600,000. One interesting point is if you look over at the single column, that same rate kicks in at $500,000. So the traditional marriage penalty, that you used to talk about is kind of back, because if you think about it, if you have 2 single people each making $500,000, no portion of their income is ever going to be taxed at 37%. Whereas if you have a married couple making $1 million, they're going to have $400,000 of their income subject to the 37% tax bracket. So that's what we mean by the marriage penalty. A couple other little things to keep in mind: the sneaky taxes, the net investment income tax of 3.8%, and the additional Medicare tax of 0.9%. Those are still around. And also the capital gains rate and the special rate on qualified dividends, those are still here, and they stay the same. One thing I would like to talk about, because when we're talking about tax rates, for a lot of clients, they are also subject to the alternative minimum tax. So I think it's important just to go through that for a couple of reasons. One, I'd like to demonstrate why this alternative minimum tax is probably not going to impact as many people as it used to. And we'll also see that the much ballyhooed loss of state income tax deductions is really not going to be the end of the world for people, especially if they were subject to the alternative minimum tax in the past. So let's just go through a scenario. I've made the math very easy, and the goal here is not to teach the intricacies of the alternative minimum tax. So in our scenario, let's focus on the 2017 column. So we have a married couple. They have combined wages of $500,000. Their tax deductions, they have charitable contributions of $10,000, real estate and income taxes of $51,600, mortgage interest of $20,000, and miscellaneous business expenses of $10,000. Under the old law, there's something called the peace adjustment, and since this couple's income is above the threshold, they lose $55,866 of their deductions. They end up with $86,014 of itemized. That's more than their standard. So they use that, and they have a taxable income of $413,986. So the tax on that is going to be $111,832. But we can't stop there. We have to take a look at the alternative minimum tax. And in this situation, and we'll go through the details in a minute, in this situation, their alternative minimum tax is $13,989. So their total tax, once you add the alternative minimum tax and the sneaky taxes I mentioned before, you're at $128,071 for 2017. Let's take a look at how the alternative minimum tax is actually calculated. So we start with the $413,986 of taxable income, and then we have to start adding back things that are not allowed under the alternative minimum tax. So the first thing we do is we add back the miscellaneous deductions in full. They're not allowed, so that's a $10,000 add back. Taxes are not allowed, so that's a $51,600 add back. And then, since the IRS is always trying to be fair to people, you didn't get all your deductions because of that piece adjustment, so they let you subtract that out. You end up with alternative minimum taxable income of $470,000. So you can see if you compare your 470 of alt-min income to your taxable income of 413, that's a pretty big disparity. So that's a clue that we're probably going to be subject to the alternative minimum tax in this situation. You then get an exemption, which could be as high as $84,500. Because of this couple's income level, their exemption is only $7,225, leaving alt-min income of $462,775. The alternative minimum tax is, it's a little bit is taxed at 26%, the rest is at 28%, so it's roughly a 27% bracket. So the alternative minimum tax is $125,821 compared to the $111. That's a $13,989 difference, and that's the amount you pay. So let's go back and take a look at the 2018 column under the same scenario. So we have $500,000 of income. That doesn't change. And now let's look at the itemized deductions. Now we're going to go through these in great detail because a little bit later, because this is a major area of change for us. But charitable contributions, there's really no change there, so they still get $10,000 of those. Probably the biggest change to itemized deductions is the area of real estate and state income taxes. Those are capped at 10. So even though they had $51,600, the most they can deduct now is 10. Interest expense, no change in this situation, so they're still at 20. And miscellaneous deductions are no longer allowed. So their total deductions are 40. That's more than their new standard deduction of 24. So now their taxable income is 460. So let's see how that plays out from a tax standpoint. So the tax on 460, given the new tax rates, is $112,379. So their taxes have gone up by about $500. But if you look at the next line, their alternative minimum tax is now 0. So in total, whereas last year they would have paid $128, this year they're only going to pay $114,600. So their taxes are going down by about $14,000. So let's take a look at the alternative minimum tax calculation under the new law. So we start, taxable income is higher than it was because obviously we don't have as many deductions. So we're starting at 460 now. We don't have to worry about adding back miscellaneous deductions because they weren't allowed to begin with. We do have to add back our $10,000 of allowable taxes. We don't get any type of piece adjustment since that no longer exists. So we end up at 470 of alternative minimum taxable income. And you can see the 470 is very close to the 460. So maybe we won't be subject to alt-min. The other thing that's happened now is the alt-min exemption has gone up, not substantially, but it's now 109.4 instead of 84.5. But more importantly, the phase-out level where you start to lose the exemption is much, much higher. So in this case, they're going to get the full exemption, which leaves them with alternative minimum taxable income of only about 360 and alt-min tax of only 97,000, which is lower than the regular tax of 112. So they no longer need to worry about the alternative minimum tax. So the point I was just trying to make there was a few things. As I said, one is less people are going to be subject to the alternative minimum tax, and losing deductions. Some of these deductions may not be as dramatic as it could have been. Now, Steve, the projections I've been doing for clients for 18, I haven't had anyone yet subject to alt-min. Have you?
No, I haven't had a single person subject to the alt-min. I think that with this new tax law, you're going to see a lot fewer people subject to alt-min.
Yeah, I think the one situation where we'll still see it are clients who exercise incentive stock options, because those can be big numbers and they are still a preference item. So I agree that we're going to see much less impact from the alternative minimum tax.
All right, we're to our first polling question. Polling question number 1. What impact has the alternative minimum tax had on your tax liability? No effect, minor effect, or major effect? Let's just take a minute while people respond to that. The first CPE word of the day is January. The first CPE word of the day is January.
Okay. All right, Steve's going to talk about what's going on with personal exemptions under the new law.
All right. So personal exemptions. The old law allowed for personal exemption for every member of your household. In 2017, that personal exemption is going to be $4,150. However, under the new law, the exemptions have been completely repealed. For a person in my situation, I've got a family of 6. My personal exemption deduction was about $24,000. In 2018, that'll go away entirely. But something else that they've changed, and I think this is for the better, is they've increased the child tax credit from $1,000 up to $2,000. And they've increased the phase out for this tax credit from $110,000 up to $400,000. So a lot of individuals who had phased out of the child tax credit for kids under 17 and under, will now actually be able to capture this tax credit. And the tax credit is much more beneficial to you because it's a dollar for dollar reduction on your tax, where an exemption was actually just the tax rate times the exemption amount was the tax reduction that you got in that way. Something else that they've adjusted is that the tax credit, child tax credit, is now refundable up to $1,400. So if you've gone through all the way through your 1040 and you come to the end and your taxable or your tax is zero, you can still actually get a refund from this tax credit. So if you have 2 kids, your tax refund would be $2,800. This will really benefit low-income households and lower middle class.
So Steve, given a family of your size, when you ran your projection, you lost your exemptions, but you're getting credits, expanded credits. How'd you come out?
I came out for the better, for sure. Having an $8,000 credit over a $4,000 credit is more beneficial, and the fact that it is a dollar for dollar drop in tax is going to be much more beneficial than the exemption was.
Okay. So the standard deduction, here's a chart for you, but basically what they've done is virtually double the standard deduction for everybody. So you've gone, if you're a married couple, you've gone from $12,700 up to $24,000. And it was interesting. I asked Steve what percentage of people he thought claimed the standard deduction, and he actually said like 90%. It's actually like 75. I thought he would guess a much lower number because virtually none of our clients claim the standard deduction. But it's about 75% of the country now claims it, and they think it'll be up to about 85% with this new increased standard deduction. And interestingly enough, as we've done planning for clients, we are actually going to have a number of clients who will be claiming the standard deduction going forward, and we're going to be talking about that in more detail as we start our discussion of itemized deductions. So I thought for itemized deductions, the easiest way to approach it would be just to take Schedule A is where you calculate your itemized deductions on your tax return. So I thought what we would do is just take each section of Schedule A and discuss the changes and the strategies associated with each type of deduction. So let's start with medical expenses, and not a dramatic change here, but it's interesting because at one point the House bill was actually proposing to eliminate medical deductions, and what the final bill did was actually increase the benefit a little bit. So you see the 7.5% that's circled on the slide. For the past, I forget, maybe 5 or 7 years, that percentage has been 10% of income. So what that means is if you have $100,000 of income and you have $10,000 of medical expenses, you weren't getting any deduction because 10% of $100,000 is $10,000. You didn't reach the threshold. If you had $11,000 of medical expenses, you got to deduct $1,000. You got to deduct the amount in excess of your threshold. So for 2017 and 2018, the threshold has dropped to 7.5%, which is what it used to be a while back. So this is a provision that actually is going to impact the tax returns we're preparing right now, because like I said, it's effective for 17 and 18, and then in 19 we go back to 10%. The strategy here for medical, the new law doesn't affect it. It's the same strategy it's always been, which is if you find yourself in a situation where you're very close to meeting the threshold, either because you've had a low income year or maybe you've had dental procedures or something where they tend to be expensive and insurance doesn't cover them, you might be near being able to actually deduct your medical expenses. If that's the case, what you want to do is incur as many optional medical expenses as you can before the end of the year. So you buy a lot of contacts, you go to the dentist, you go to the eye doctor, you get a physical, just all the stuff that you really would probably do the next year anyway, hopefully, maybe not. accelerate them into a year where you know you're going to be above that threshold, just to guarantee you can get the deduction. The next section of Schedule A is the itemized deductions, state and local tax deductions. So this is the area that there was a lot of press coverage because it was really chaotic near the end of the year because everyone knew they were going to be capped out at $10,000, so they were trying to prepay real estate taxes, and some jurisdictions weren't accepting the payments. Then all of a sudden they allowed you to make the payments, and the IRS said that's great, but you can't deduct them. So it got pretty crazy there at the end of the year. But the adjustment itself is actually pretty straightforward. You just take all the various types of taxes that you see here, and you're capped at $10,000. So for most clients, there's not a lot of planning to do because they're going to be well above the $10,000 and they're just stuck with $10,000. But if you're in, like, let's say we have a number of clients in Florida which has no state income tax, it could be possible that maybe, let's say you have $20,000 of real estate taxes. You may want to be in a situation where you're just always making sure that you at least have $10,000 to claim in a single year so that you still get the cap. You never want to be in a situation where you get a $20,000 deduction in one year and zero the next. So that's it's a major change, but like I mentioned, if you were in the alternative minimum tax, the change isn't really going to hurt you that much. The next section is the mortgage interest deduction. And again, there are some pretty substantial changes here. So let's kind of start by reviewing the current law for mortgage interest. So the way mortgage interest works right now, there's two types of deductible mortgage interest. One is acquisition debt. The other is home equity debt. And acquisition debt is just as it sounds. It's the debt that you use to acquire your home. But it's also debt used to improve your home. And you're allowed to, the way it works, acquisition debt has a $1 million cap on the principal amount that you're allowed to consider to deduct the interest on. And you can spread that cap over two homes, your principal residence plus one other. So in addition to the $1 million cap on acquisition debt, there's another category of debt called home equity debt. And the thing about home equity debt is, for the IRS, that is actually, or for the IRS, that's an actual technical term, whereas we think of home equity debt as a second mortgage or a home equity line or something like that. They have a more specific definition of that. So let me give you an example. Let's say that I have a lot of equity in my home and I borrow $200,000 against it. I use $100,000 of that to renovate my kitchen and a few bathrooms. I use $50,000 to buy a vehicle, and I use the other $50,000 to go on a great vacation. So the IRS would take a look at that $200,000 and they would say, okay, $100,000 of that is actually acquisition debt because it was used to improve my home. So I can move that over to the acquisition debt pile, and as long as I was below the $1 million, I got the full deduction for that. The remaining $100,000 was okay because it's debt secured by my home, and the old home equity debt rule was as long as you had debt secured by your home and it didn't exceed $100,000, no matter what you used it for, you could deduct the interest. So what the new rules say, they've made two changes. One is to acquisition debt. The new limit on acquisition debt is $750,000. And home equity debt is no longer deductible at all. But remember, home equity debt does not include money that you borrowed against your home that you used for improvement. So it's important, as we move into 2018, that you go back and try to resurrect your records to be able to substantiate that your home equity debt was actually used for home improvements. That will allow us to treat it as acquisition debt, and as long as you're below the thresholds, we can deduct it in full. This new $750,000 limit applies to mortgages put in place after December 15, 2017. So old mortgages are grandfathered in, but there is no grandfathering for home equity debt. So home equity debt is just gone. So I think that's, there's really no great planning to do in this area. Your mortgage interest is kind of whatever it is. I mean, obviously, if you're going to take out a new mortgage and you can get below the $750 to make sure it's all deductible, that's fine. But but oftentimes mortgage rates are pretty low. So even if you can't deduct it, it may not be a bad use of your money. But that's something that would have to be decided on a case-by-case basis. The next section of Schedule A is charitable contributions. And this is actually an area where there could be some pretty interesting planning, but let me go ahead and just give you the basic changes. So One change is cash contributions have always been limited to 50% of your adjusted gross income, which is obviously a huge limitation and not a factor for many people. But that limitation has been increased to 60% of AGI. That does not apply to contributions that you're carrying over that you couldn't deduct in prior years due to AGI limitations. It only applies to new ones. And like I said, it probably isn't a factor for most people. Something else that another change they made is that, for instance, if you give money to Georgetown and as a result you get preferential treatment to get seating rights for basketball games, there's no deduction for that any longer. So where the planning comes into place with charitable contributions, let me give you an example. Let's say that we have a client. They're going to get their $10,000 of state and local taxes, and they've got a $4,000 mortgage interest expense. So their itemized deductions are $14,000, and they're a married couple. We know that their standard deduction is $24,000. So they can claim the standard deduction, and even though they only have $14,000 of deductions, they're going to get to deduct $24,000. Let's say that they, on an annual basis, they normally give about $10,000 to charity. If they make that $10,000 contribution in 2018 under this scenario, they're not going to get any benefit from it because you're going to add the $10,000 to their itemized deductions, which is going to raise their itemized to $24,000, but that's the same as they were already getting under the standard deduction. So it doesn't really do them any good at all. So we need to come up with a strategy to help alleviate that problem, and here's the strategy. If you're in that situation, what if you gave 3 years worth of contributions in 1 year? So now instead of giving 10 a year for the next 3 years and getting no deduction, you give $30,000 all at once, and you can deduct all of it except for the $10,000 that got you to your standard deduction level. So now at least you're going to get a deduction for $20,000, and you could do that every third year. Some people don't like the idea of giving a lot at once and then giving nothing in the intervening years. The way around that is, in my example, you could give $30,000 to a donor advised fund. You get the deduction the year it goes into the donor advised fund, but then you pay your contributions the next few years out of that donor advised fund. So you're still making contributions on an annual basis, but you've gotten your tax deduction all in year one. So I was meeting with a client just the other day actually, and it really is a really good strategy, and I think it's going to be one for a lot of people to consider given this increase in the standard deduction. Another strategy for charitable giving really falls into really affects a very specific group of people, but if you're over age 70 and a half and you're receiving your required minimum distributions from your IRA accounts, you can actually direct those distributions directly to charity. And the benefit of that is if you took the money out of your IRA, that's income, and then you write a check to charity, under my scenario, you're not going to get any deduction for it. But if you direct your IRA custodian to distribute the money directly to the charity, what happens is you don't have to count that as a charitable contribution. Instead, the taxable portion of your IRA is actually reduced. So let's say you're going to have a $100,000 RMD. If you direct $10,000 of that to charity, you're now only going to pay tax on $90,000 of your RMD. So in essence, you're getting the $10,000 deduction, and you're still going to get your $24,000 standard deduction. So that's the strategy for charitable contributions, just kind of bunching them together. If you're in a situation where the standard deduction could be an alternative. You know, if you're in a situation where you've got your $10,000 of state taxes, you've got a big mortgage, so you're already up there over the $24,000, then it doesn't really matter. You just continue doing what you're already doing. So the final part of Schedule A is miscellaneous itemized deductions, and these generally fall into 3 categories. We have unreimbursed business expenses, tax preparation fees, and investment fees. So for tax preparation fees, the strategy is if there's anything else going on in your tax return where you can move the fees, that's what we're going to do. So for instance, if you have a sole proprietorship Schedule C, we're probably already taking your fees on that form, but if we're not, we'll move them over there. If you have a rental property, we can move the fees over to the rental schedule. If you're a partner in a law firm, we can move the fees over to offset your K-1 income from the law firm. So that'll be the strategy there. For investment fees, there's not really a lot you can do. The only opportunity is if you have investment fees associated with your IRA account, oftentimes they will give you the opportunity to write a personal check to pay those fees so that it doesn't have to deplete your IRA. If you do that, you're not going to get a tax deduction for it, obviously. If you take them out of your IRA directly, you are in essence getting a tax deduction because you're reducing the amount of your IRA, which you'll have to take out at some point and pay tax on. But unless you're older, like probably 70 and above, you're probably still better off just writing the check, even though it's non-deductible, because there's going to be a better benefit to letting the money stay in the IRA and grow on a tax-deferred basis. Probably the biggest area in itemized deductions is the employee business expenses. So you got situations where, for instance, I have a client who's an outside salesman. They put a lot of miles on their car. They could end up with $20,000 or so in unreimbursed business expenses. So let's just do an example. Let's say they make their salary is $100,000. They don't get reimbursed by their employer at all for their auto use, and they know they spend at least $20,000 between gas, insurance, and everything else. If they continue the way they are now, where they're just paying that out of pocket, they're going to get no tax deduction for it, so it's just completely lost. What they could do is approach their employer and see if the employer either has or is willing to put in what's called an accountable plan. And under that plan, the employer could reduce, and this, in my example, reduce this employee's salary to $90,000, or I'm sorry, to $80,000, but give them the $20,000 to cover their auto expenses. That would be tax-free to them. So again, in essence, you're reducing your income by the $20,000. You're just doing it a different way than electing itemized deductions. So that's a good strategy, and I think a lot of employers are going to become more familiar with the accountable plans, since this is going to be such a big deal for a lot of people. So that kind of covers the itemized deduction area. Just, again, in summary, a lot of deductions are no longer allowable. If you were in alternative minimum tax, it may not be the end of the world that you've lost these. There are strategies, especially in the charitable area, when it comes to just bunching together deductions. So again, it comes down to a case-by-case basis, but I think it just kind of points out that we just need to pay a little more attention to year-end tax planning, even for some clients who in the past it really wasn't a big deal.
All right, we've reached our second polling question of the day. If your charitable contributions are no longer tax deductible due to the increased standard deduction, what impact will this have on your willingness to give? A, none, B, minor, and C, major. And while we take a second for participants to be able to answer that question, the second CPE word of the day for those looking for CPE is winter. Again, the second CPE word of the day is winter.
Okay, let's keep going. So this next page is really just a summary of what we've already discussed, except for the two items down at the bottom. So there's been a major change with regard to alimony, and one important point is this is effective for instruments executed after December 31st, 18. So it's after 18. And the new rule is that alimony is not deductible by the person paying it, and it is not income to the person receiving it. So that's going to change the dynamics a little bit in divorce settlements. And then the final one down here is the deduction for moving expenses has been repealed, except for a situation involving military people. So that kind of sums up, the basic individual changes. Let's start in on some of the changes affecting business pass-throughs. And we're going to do a whole separate hour on the changes in business rules starting at around noon. So I'm not going to spend a lot of time on this, but I wanted to just kind of do an overview. So if there's anybody participating right now who's not going to be able to stick around for the second hour, they'll at least get the overview. And if you want more information and you can't stick around for the second hour, the webinar will be posted on our website. You can always access it at that point. So the general rule is that taxpayers are entitled to a deduction equal to 20% of their qualified business income from a pass-through entity. One important note, a sole proprietor is a pass-through entity, so if you have a Schedule C and you've never become an S Corp or an LLC or anything like that, you don't need to rush out and do anything. You're still entitled to this deduction. So the net effect of this is really creating a top marginal rate of 29.6, which is 80% of 37%. And these rates also apply to trusts and estates. So keep in mind, this is just the very top level. We need to drill down a little bit just so people don't get too excited, because obviously there are going to be some limitations on this. So let's talk about the limitations. So the first limitation is a taxable income limitation. And the way it works is if your income is below your taxable income is below $315,000 for a married couple, or $157,500 for a single person, then it's really simple. You get the 20% deduction. No questions, no issues. If your income goes above $315,000 and you're married, or above $157,500 single, then you're subject to a second level of testing. So let me just point out one thing. It's kind of interesting that the deduction we're dealing with is 20% of your qualified business income, but the income thresholds are based on your actual taxable income, not your business income. So let me just give you a quick example. Let's say that the example I just used, let's say you have a sole proprietorship and you make $100,000. Well, you would think you'd be entitled to your 20% deduction because you're way below any threshold. But what if your spouse has a W-2 making $1 million? All of a sudden, because your taxable income is above the threshold, you have to go through this second level of testing. So let's describe the second level of testing. So we start off with just the basic, 20% of your qualified business income. That's the most you could ever get. If your income is either in this phase-out range or above the phase-out range, you then have to do the second level of testing. So the first test is 50% of W-2 wages paid by the entity. The second test is 25% of W-2 wages plus 2.5% of the unadjusted basis of any property used in the business. So we're going to do tons of examples of this during the second hour, but I could give you a real simple example off the top of my head right now. Let's just say that business income was $100,000, so your limit is $20,000. You have a spouse who makes a ton of money, so you're over the threshold, so you have to do the second level of testing. And let's say that your company paid $50,000 in wages. They don't really have any property, so you're not going to worry about the second part of this test. So if you have $50,000 of wages paid out, 50% of that is $25,000. So your cap would be $25,000 on that test, but you're already at only $20,000 under the first test, so you'd get the full $20,000. But like I said, we're going to do a ton of examples of this in the second section. So the important takeaways are, the basic rule is you get a 20% deduction. There's going to be a phase out if your income exceeds these taxable income levels. The other point is if you're a specified service business, and again, we'll spend more time on this in the second hour, but for now, you just think about health providers, accountants, lawyers, consultants, those types of businesses. If they go above this threshold, they get no deduction whatsoever. So if you're a surgeon and you have an LLC set up and you're making $1 million, you're not going to get any benefit from this provision whatsoever. Like I said, we'll spend a lot more time on this in the next section, but for now, that's just kind of your overview. Steve, can you kind of walk us through some of the new education provisions?
Yeah, so Section 529 plans have changed a little bit for the better. You can now use distributions of up to $10,000 for qualified expenses for elementary and high school. And qualified expense for elementary school and high school would be pretty much just tuition.
Yeah, so that's an important point because qualified distribution or qualified expenses for higher education include room and board, computers, lots of stuff. But for elementary and high school, it's strictly tuition. Another important point about this, and this is kind of an important point in general, is just because the IRS decides to disallow a deduction or allow a deduction or make a change in something, doesn't mean that your state of residence necessarily is going to follow along. So obviously the new tax law is only a month old, so states really haven't figured out what they're going to do, other than I guess maybe New York is suing the government or something like that. But other than that, there's not much has come out to tell us what the plans are at the state level for either following or not following these changes. But one issue that has come up with the 529 plans is, just because the IRS says that a qualified expense is now elementary and high school tuition, the 529 plan itself has to allow that, and most of them do not. So the states are going to have to determine whether or not they're going to allow this to be a qualified distribution. The local states in the area, I checked last week, no one had anything on their website concerning this. Maryland did have a link to an article in the Baltimore Sun that talked about this, so I don't know what the implication of that is. But there has been at least one state that came out, somewhere in the Midwest, that came out and said that they are not following this. And there's been a number of other states that have come out and said that they are going to follow it. So it's just something to stay tuned for. It's only at $10,000. You can only use $10,000, and private school is very expensive. So I would assume, probably the best thing to do is wait until the fall tuition is due, and by then we should know what's going on.
All right, we've reached our third polling question of the day. If you currently contribute to a 529 plan, to which state are you contributing? D.C., Maryland, Virginia, or other? And while we take a second for participants to put that polling question in, the third CPE word for the day is weather, W-E-A-T-H-E-R. Again, the third CPE word is weather.
Thanks, Steve. So another provision that is important, although it's not going to affect a lot of people, is the estate tax exclusion has been doubled. So it went from $5 million up to $10 million. And those numbers are adjusted for inflation. So it currently stands at $11.2 million, and that's per person. So a couple has an over $22 million exclusion. Now, a couple things to keep in mind is that this does sunset in 2025. So, it's great, but if depending on your age, you may be around beyond 2025, and then you're right back to where we are right now. It'll continue to be adjusted for inflation, so maybe you'll be closer to a $6 million exemption, something like that. And I have clients who are very tax averse, but the one thing they're not willing to do is be dead by a certain date just for a tax saving. So I don't think there's a lot of planning to do there. They do have one thing that was important, I think, is that the basis adjustment for the estate rules, and that basically means if you inherit, like let's say your parent dies and you inherit their home, your tax basis in that home is the value on the day they died. So if you go ahead and sell that house quickly, you're not going to pay any tax because your basis is going to be more or less equal to the sales price. So that's an important provision, and it is still in there, which is really good. Let me just cover one other thing that I don't have a slide for, but it kind of came up in the tax law. It might again, it's one of these things that's not going to affect a lot of people, but it may be of interest. So Roth IRAs have been an interesting vehicle for tax planning. What we usually see is a situation where a client, maybe for whatever reason, their income is dramatically down, and yet they still have the same itemized deductions in place. So, maybe they have $25,000 of mortgage interest, a bunch of state taxes, a bunch of charitable. Now the state taxes will now be limited, a bunch of charitable and things like that. But because they don't have much income, all those itemized deductions or a lot of those deductions are just being wasted. So a great strategy in those situations was to convert part of your regular IRA into a Roth IRA. Because the idea is that by converting, you're recognizing income, but that income is being offset by the deductions that you aren't able to use anyway. And now you have a Roth IRA, which is going to grow completely tax-free, and you can take it out whenever, and you're not going to pay taxes on, or not whenever, but you're not going to pay taxes on any of it. So that was a really good strategy, and Roth conversions also made sense in some other situations. One of the great things about the Roth conversion was the flexibility of it was really unbelievable. So you could, and there were actually some professionals out there who suggested that at the end of the year, every year, you convert your IRA into a Roth every single year. Because what the IRS would allow you to do was up until the time you filed your tax return, you could just undo your conversion. So if you had an IRA, let's say you had $1 million IRA and you converted it to a Roth and the market just tanked, so now your IRA is worth only $800,000. Well, the conversion was a horrible idea because now you've got a Roth that's worth even less and it doesn't do you any good that it's tax-free. So you were allowed to just redo it and just say, hey, you know what, I shouldn't have done that, so I'm going to act like I didn't do it. So that was called a recharacterization of your Roth conversion. That is no longer allowable. So you can still do Roth conversions, which is just converting a part of your IRA, your regular IRA, to a Roth IRA. But once you've done it, it's set in stone. You cannot undo it anymore. So it's not a huge deal, but in some situations, it could be important. So I think we've reached the end of the presentation. So what we'll do now is take some questions. Let me just see the questions we have.
I can give you the questions, Walter. So one of the first questions is it 17 and under for the child tax credit, or is it under 17? I looked into this. It's if your kid is under 17 at the end of the calendar year, you get the tax credit, the child tax credit. So it is not 17 and under, it is under 17.
That is, yeah, I believe that is correct. Here's a question where someone's saying, didn't they change the rules on selling your principal residence?
Oh, yeah.
And the answer is no. They talked about it. I think what the provision was, they were going to make you live in your house for 5 out of 8 or something like that. But they didn't change it. So let me just kind of review that rule because that can be a confusing one too. I think every year we have someone ask about rolling over the gain from one house to the next, and that hasn't been the case for pretty much forever. So the way it works now is if you're selling your principal residence, as long as it has been your home for 2 out of the 5 years before you sell it, if you're a married couple, you're entitled to exclude $500,000 of gain. If you're a single person, you get to exclude $250,000 of gain. So just do a quick example. Let's say you bought a house for $500,000. It's now worth $1 million. You sell it for $1 million. You lived in it for 2 out of 5 years. You'll pay no tax. And it doesn't matter what you do with the proceeds. So it's a nice rule if you're downsizing and your gain falls within that threshold. It's a bad rule for a lot of our clients who maybe bought a house in Chevy Chase 60 years ago for $30,000 and it's now worth $1 million. Because even if let's say they move into a new $1 million house, it doesn't matter. The rollover rules are gone. They have a big gain and they can only exclude $500,000 of it. Just keep in mind, if you are going to sell your house, try to pull together to the best of your ability all your paperwork on any improvements you've made to your home while you've owned it. And we go through this a lot with clients, and obviously not everybody's great about keeping records. So, I mean, the best thing to do is just to keep a running record. Every time you do an improvement, just put it on an Excel spreadsheet or write it down somewhere and keep it in a file. But even if you haven't done that, there's nothing wrong with sitting down and saying, okay, yeah, we did a fence back in 1980 and that cost $10,000, or just kind of trying. What I'm trying to say is you can still make the list now with your best estimates. Another question. Okay, this is a good question. All right, so this person is saying, I'm an employee of a company. I have a lot of business deductions, and I make less than the threshold to get the 20% business deduction. Can I form an LLC and be a contractor with my employer? Okay, that's a good question. The first thing about that is the 20% deduction specifically says that it does not apply to services between an employee and an employer. But what you're suggesting is stop being an employee and become a contractor. Theoretically, you could do that, but a few caveats. One is the IRS has very specific rules in defining who is an employee. So just because you form an LLC, if you're providing services to only one person or one company, and they control what you do, and you can't really, there's really no risk of you losing money, chances are you're still an employee for all intents and purposes. The other thing to think about is, as an employee, you may actually be receiving, a number of benefits. Number one, your employer is paying half your Social Security tax. They may be paying your health insurance and other benefits, and you may be participating in a qualified plan of some type. So, that's something you really have to think about. I see very few situations where that's really going to make sense. I do have one guy who is a salesman, and he represents more than one. He has the ability to represent more than one company. So he'll probably be, and he has a ton of business miles. So he'll probably be in a situation where that might make sense if we can make it work. But I don't, and in general, that really is not a strategy that's going to make sense. So let me see what other questions we have. Is there any change in the loss deduction, capital loss deduction for investments, or is it still limited to $3,000? There's been no change in the capital loss rules. You still net your gains and losses, and if you have excess, you can use $3,000 to offset other income. Question, if a mortgage loan contract is signed with a lender before the 17th, December 15, but closing is not complete until January of 18, and it's over 750, is that loan grandfathered? And the answer is yes to that. Is there a cap of $50,000 on total allowable deductions? No. I'm not sure where that belief may have come from, but no, that there is not. Let me just see. Does the 20% pass-through deduction apply to rental income? Yes, it does. And the important thing to think about in the context of the rental property, and again, we'll be discussing it in detail in a little while, if you're over the income limits, so let's say, you're a married couple and your taxable income is $600,000, so you're over the limits, and you don't have it, rental property is not a service business, so all that means is that you're going to have to then put yourself subject to the next level of testing. You don't just get the 20% right off the bat. So if it's a rental property, chances are there's zero wages. So the first part of that second test is going to be zero. And then the second part of that test is going to be 25% of wages, which again is zero. But then you get to take 2.5% of the cost basis of the rental property itself. So if it was $1 million rental property, you'd get at least have $25,000 as your second cap. So that could be a situation where that's probably going to be the situation where that adjusted asset balance comes into play. And the other important point about that is when they talk about the adjusted asset value, that's the value of that's the cost of the asset the day it went into service. So even though you've been depreciating it, you don't need to worry about that. It's your actual cost. And I'm not going to go into a lot more detail on that right now, but that's the way that works. Are you ready? Let me just see if there's any other questions. Can you explain the rule concerning alimony payments? Sure. So after agreements entered into after 2018, alimony basically has no income tax effect whatsoever. So under current rules, if you're paying alimony, you get to deduct it. If you're receiving alimony, you report it as income. And the reason this was important is because in many situations, the person paying the alimony was in a higher tax bracket than the person receiving it. So what that meant was they could afford to pay more alimony because they were getting a deduction for it. The other person was paying very little tax on it. So you kind of do an analysis and come to a nice middle ground on alimony. Under the new rules, no deduction, no income. So it's pretty simple, but it's going to have a dramatic effect on investment income. Let me just look at any other questions. What do you want me to do? Let's see. I don't really. Oh, yes, okay. Are health insurance premiums allowable medical expense deductions? Yes, they still are. I think that is pretty much all we have time for, so I appreciate that. So we're going to go ahead and get ready to start the second presentation, which is going to be corporate tax. So if you want to stay tuned, what we're going to do is we're going to switch out Steve Boisvert, who has been kind enough to help moderate the individual section. We're going to trade Steve out for Pat Ennis, who is the founder of Ennis Legacy Partners. Pat and I have known each other for over 20 years and been working together for probably over 10. And where we work together is helping business owners strategize for the exit from their business. So I'm going to let Pat explain who he is and what he does, but I'm very glad to have him join us for this second part.
Thank you, Walter. I appreciate being here. Thanks for including me today in this important webinar. I really appreciate it. Yeah, Ennis Legacy Partners, we're a business consulting firm with an emphasis on helping business owners plan their eventual exit. We want to help business owners build transferable value or value that someone else is going to want to buy or own at some point, and then exit on their own terms and conditions. So Walter, where do we start this discussion today, the new tax law, and how it relates to businesses?
Well, I think the best place to start is the easiest place to start, which is the new corporate tax rates for C corporations. So let's just do just a really quick little background piece. So there's different types of business entities. So we have C corporations, which is all the publicly held companies, Apple, IBM, all the publicly held companies are C corporations. And then you have a whole nother type of entity, which is basically flow-through entities. And they can be things like LLCs, limited partnerships, general partnerships, S corporations, and I'd even throw sole proprietorships into that mix. So the big change as far as C corporations go is they now enjoy a flat 21% tax rate. So you can see the rates that used to be in effect. It was graduated, you started at 15, ended up at a maximum of 35. Now it's just flat 21%. Doesn't matter what type of business you are, really, it's pretty much very simple. You just have a 21% flat tax rate.
All right, well, as you know, most of the clients we work with are S Corps and LLCs. Do you think in light of these lower C corporate tax rates that we'll see companies, businesses more switching to a C Corp structure?
That's a good question, but I don't really think so. And, if you think back to, the work we do with exit planning, if we're trying to help an owner of a C corporation sell their business, the big problem we have is trying to plan around the double layers of tax that C corporations are subject to. So in most situations, a buyer wants to buy a company's assets as opposed to buying their stock. But if they buy the assets of a C corporation, the C corporation itself is going to pay tax on the gain on the sale of those assets. Then they're going to distribute the proceeds to their shareholders, and their shareholders are going to pay tax again on the proceeds. So, and of course, even if they're not selling, the same thing happens on an annual basis. The C corporation is going to pay tax on its profits, then it's going to pay out the profits, and the shareholders are going to pay tax again. So I don't think you're going to see a big migration to C corporations.
So then what situations will make sense for a business to be a C Corp?
I think where you're really going to see it is a startup company whose goal is to plow all their earnings right back into their company, really grow it, maybe go public, or just get really big, because in that situation they're going to be retaining earnings, not distributing earnings. So there's definitely a benefit in that situation. And we have clients, a lot of our clients are personal service clients like lawyers and stuff like that, and there can be situations where they make a lot of money, so maybe they don't need to distribute it all out. So they could think about retaining profits in their corporation. The interesting thing about that is the whole concept of retaining profits in a corporation has really not been a strategy for probably over 20 years. But because it used to be a really important strategy, because if you think about it, individual rates used to be in excess of 50%. So there was a real incentive to accumulate retained earnings inside a corporation. So back a long time ago, the IRS put in some very specific rules to prevent that, and they have what they call personal holding company rules and they also put in an accumulated earnings tax. So, in a situation where you're like a service business, I mean, maybe you can accumulate some earnings and then pay them out when you're in retirement, but generally speaking, that's really not going to be a great viable strategy.
Well, then what are the benefits for the flow-through entities, the S-Corps and the LLCs? How are they going to benefit?
Okay, so this is where it's going to get complicated. So let me just kind of lay out my strategy here for presenting this. So we're going to just go through basic rules. Then we're going to have a flow chart, which I think is going to be pretty helpful. And then we're going to do lots of examples. So by the time we're done with the examples, I think everyone will have a pretty good understanding of how these rules work. But let's just go ahead and start with the basics. So if you were around for the individual part, this is the exact same slide. So here's the basic rule. For anyone generating qualified business income, which is business income from a pass-through entity or sole proprietorship, they're going to receive a deduction equal to 20% of that income. So basically, they're going to be paying tax on 80% of their business income, which takes that rate from 37% top rate down to 29.6. And this does apply to trusts and estates. So that's the general rule. But before everybody gets really excited about it, keep in mind that there's always caveats to everything. So let's start discussing the limitations on this. So the first limitation is an income limitation. And the way this works is for married people with taxable income in excess of $415,000, you have to start dealing it with a more complicated situation. So you don't just get the 20%. Instead, you got to go through a second layer of testing. And that layer of testing is based on the amount of wages that the company pays. And in the second component of that test, it's based on a percentage of wages plus a percentage of the basis of the assets used by the business to generate income. So like I said, we're going to go through lots of examples, so I'm not going to delve into numerical examples at this point. The threshold for single people is 2075, half of the 415. Another thing is that if you are a specified service business, and we'll talk about that, and your taxable income is in excess of the threshold, you don't even get to go through this second testing. Instead, you just do not get the 20% deduction. And then for income, they have a phase-in for income between 315 and 415 of taxable income. Even if you're a service business, you do get to use the second level of testing, and you may get some phased-in deduction. For single people, again, the limits are half. So the phase-in starts at 157.5 and ends at 2075. So let's start delving into the rules a little more in detail. So specified service business. And obviously you can read the slide as well as I could, but here's the basic gist of it. I mean, you can always think of service businesses as being health, law, accounting, consultants, brokers, athletes, people like that. Traditionally, it's always included engineers and architects as well, but I guess the architects and engineers have really good lobbyists or something, because somehow they managed to get themselves exempted from this definition, which is great for them. So, at any rate, it's the traditional businesses you would think of as service. So, if you're billing somebody on an hourly rate, or if what they're paying for is your knowledge as opposed to a product, chances are you're a specified service business. And if you look at that last sentence, this is actually a little scary because, or the last part of the sentence, it's a little scary because this is something that's been added where it says, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So, that really could be a very wide-ranging group of businesses. If you think about it, almost any business can look back to the reputation of its owner or its employees as its principal asset. So that was a little scary, but if you look at it deeper, the committee reports, they kind of point you back to the old rules defining personal service corporations in regard to their ability to use the cash basis method of accounting. And when you go through some of the examples in those regulations, which interestingly enough are only temporary regulations, they're not even final, but they still carry a lot of weight. They do have a lot of examples in there, and as we went through those examples as a group here, we started feeling better about the fact that not every business is going to be a service business, a specified service business. And what we're going to have to do now is really, go client by client and do a few things. One is, see if there's any way that they could be construed to be a specified service business. If so, we're going to have to take a look and see, maybe they can reword the way they're contracting with their clients or something else to kind of maybe make it not. Maybe kind of recharacterize things so that it's not so obviously consulting, and maybe there's other pieces of it that they can emphasize. So it's going to be an important point because, as I mentioned earlier, if you are a specified service business and you make a lot of money, you're going to receive no benefit whatsoever from this provision. So it's an important area to look at. But like I said, for now, we're at a little bit of a disadvantage because we need regulations to come out. So let's take a look at the flow chart, which I think is really helpful. I don't know, maybe some people don't like flow charts, but let's go ahead and try this. So let's start on the left-hand side, and we're going to ask the question, is it a service business? So let's say yes, because service businesses are kind of easy. So is it a service business? Yes. Come down to the next box. Is taxable income over the threshold? Let's say yes again. Is taxable income over the full phase-in? Is it over that 415? The answer is yes. So now we have no deduction. Let's go back up again. Is it a service business? Yes. Is taxable income over the threshold? No. Well, now they get the full 20% deduction. So again, that was just emphasizing if you're a service business and you're over the threshold, you're just out of luck. If you're under the threshold, it doesn't matter what type of business you are, you're going to get your 20% deduction. Then let's go back to the second box. Is taxable income over the threshold? Yes. Is it over the full phase-in? No. So then even in the service business case, if they're in that phase-in bracket, they're going to get to do that second level of testing and maybe get a deduction out of it. So that's important. Let me just emphasize one other thing that I failed to mention. Number one is the 20% deduction, it can't be more than 20% of your taxable income. So if your only income is your business and then you have itemized deductions that reduce your taxable income, your deduction, you won't get the full 20% of business income. We'll look at some examples that say that. The other thing, I think I did mention this, but just to reemphasize, even though the deduction, the 20% deduction is based on your business income, the testing is based on taxable income. So you got to take into consideration, if you're married, all the income earned by both spouses, you have to take into consideration your itemized deductions and everything else when you're calculating that threshold. So let's go back up to the boxes. We'll start on the left again. Is it a service business? Let's say no this time. So is taxable income over the threshold? Let's say no. So again, like we've said a lot, as long as you're below those thresholds, nothing else really matters. You're going to get your 20% deduction. Is taxable income over the threshold? Let's say yes. Is it over the full phase-in? Let's say no. So you're going to go through that phase 2 of the testing, and you may get a reduced deduction. Or is it over the full phase-in? Again, you're not a personal service business, so you do still get to take the second level of testing, and you may still end up with a deduction. So, the bottom line again, if you're below the threshold, no matter what kind of business you are, you're going to get the full deduction, and this includes rental properties. If you're a service business and you're over the threshold, you're going to get nothing. If you're not a service business and you're over the threshold, you'll do the second level of testing and maybe you'll still get something. And if you're in the phase out range, no matter what type of business you are, you'll do the second level of testing. Okay, so let's ask the polling question. If you are an owner of a business, what type of entity is it? LLC, S Corp, or I'm sorry, C Corp or S Corp. And the CPE word is deduction. Okay, so we've done the polling question. Let's start going through examples now. And these are not the most exciting thing in the world, but I think as we go once we go through them, I think it's really going to help everyone's understanding of exactly what we're talking about here. So let's start with just kind of emphasizing the point that Pat brought up about C Corps versus pass-throughs. So let's take a look at that. So this is a situation where on the individual level, they have taxable income of $315,000, which puts them in a 24% tax bracket. So they have business income of 100, their 20% deduction, and we're assuming in this situation there's no limitations on their deduction. Their special business deduction is $20, so their taxable income is 80. They pay 24% on that, end up paying $19.20 of tax, so their tax rate is 19.2%. C Corp in the same situation, and this will help to illustrate the double tax we were talking about. They're going to first pay 21% on the $100, leaving them $79 to distribute to shareholders. The shareholders are going to pay the special qualified dividend rate, 15%, plus because their income is at $315, they got to pay the extra 3.8 net investment tax. So they're going to pay another $14.85. So they're going to end up paying $35.85, and that's their bracket, 35.85%. So it's substantially higher than the same income being taxed to the flow-through entity. Let's do the same thing, but this time we're going to have taxable income of $600,000 or greater. And again, we're assuming that they're entitled to their business deduction. So again, $100,000 of income. They get the 20% deduction. Now they're in a 37% bracket. So 37% on 80 gives them a net bracket of 29.6%. Same income on the corporation. Again, you got 21 bucks. Now their income is higher, so their dividend rate is 20% plus 3.8. So they're going to pay even more. So now the corporate tax rate is 39.8 once you factor in both levels of taxation. And then we'll do another one. And this one has the W-2 wage limitation. We're going to do more examples with that, but we can kind of do one now. So qualified business income, $700,000. So potentially, they'd have a $140,000 deduction because that's 20% of 700. But they are subject to the wage limit. They're not a service company, but they are above the thresholds. So they're subject to the wage limit. W-2 wages are $200,000. They have no qualified business, so we don't have to worry about the second part of the test, or no qualified business assets, so we don't need to worry about the second part of the test. 50% of wages is 100, so we compare the 140 to the 100, and they're maxed out at 100. So now their taxable income is $600,000. They pay $222 in tax, which is an effective rate of 31.71%. Okay, let's take a look at an example with the asset limitation. So this would be a good example for investment real estate where the taxable income is above $600,000, so you're forced into that second tier of testing. So we have qualified business income from the rental of 70. Our deduction, maximum deduction would be $14,000. That's 20% of 70. It's a rental property, so there's no wages at all. So the first part of that test is going to be 0. But now the unadjusted basis of their assets, so the original cost of the building was $2.3 million. Multiply that times 2.5%, you get $57,500. So their deduction is limited to the lesser of either $14,000 or $57,500, so it's $14,000. So they have $70,000 of income minus 14. They pay tax on 56. They end up with an effective rate of 29.6. One point while we're discussing rental real estate, just so I don't forget, when we're going through issues later, is deleveraging your real estate could increase your 20% deduction. Because if you think about it, if you have a fairly new rental property, a lot of your expenses are the mortgage interest. So to the extent you can reduce that mortgage interest, you'll increase your qualified business income, which will increase your 20% deduction. So just a little point to make there. Let's do a service business. We'll compare pass-through to C Corp. So we have $100,000, and these people are above the threshold, so they're going to get no 20% deduction whatsoever. So they're at a 35% individual rate, so that's their tax rate, 35%. Corporation, again, they're always paying that $21 up front. They distribute out. Their shareholder income tax, 15% plus 3.8, so that's 14.85. They're then paying a 35.85% combined rate. So it's close, but the flow-through entity is still a little bit better. Same thing, this time the income is even higher. So we're still, on the pass-through side, we're still looking at no type of deduction. So they're at a 35% rate. Again, corporate income, they're always paying 21. Then they distribute the remainder. Because their income is so high, their dividend rate is now 20% plus 3.8. So their effective rate is 39.8 versus the pass-through rate of 35. So let's look at service example. This time, their income is over $600,000. So now they're in a 37% bracket, paying 37%. And the corporate rate still stays the same, 39.8. So even in this situation, the flow-through entity is still better. So now we're going to get into some very specific examples of how this deduction works. So I think this should be pretty helpful. So let's start with a sole proprietor, Taylor, married, sole proprietor, $100,000 from her bagel shop, and her husband has $34,000 of other income, and they just claim a standard deduction of $24,000. And again, the reason these other details are important, because remember, we do have a limitation based on taxable income. So net business income, $100,000, other income, $34,000, adjusted gross, $134,000. Subtract out the standard deduction, we're down to taxable income of $110,000. So taxable income is more than net business income, so we don't have to worry about that limitation. And they'll be entitled to a QBI deduction of $20,000, 20% of the $100,000. So that one's pretty straightforward. Let's do someone this time who's subject to the phase-out range. So now we have Jack, he's married, sole proprietor, $1 million of net business income from his motorcycle shop. He and his wife have $50,000 of other income, $60,000 of deductions, and this is important because he's above the thresholds. Jack's motorcycle business has $250,000 of wages and $100,000 of assets. So net business income is $1 million. Other income is $50,000, so that's $1,050,000 minus the $60,000. We're now at $990,000 of taxable income. So 20% of the $1 million would be $200,000. But right off the bat, we can see he's going to be limited because his taxable income is less than his business income. So the most he could ever get now is 20% of $990,000, which is $198,000. Because he's over that threshold, though, we have to do some more testing. So the first test we're going to do is 50% of wages. So we said his wages were $250,000. So that's half of that is $125,000. So that's, we're going to compare that to 25% of wages plus 2.5% of his asset base. His asset base is only $100,000. So that's not very much. And then his salaries, you're only taking 25% of salaries at this point. So that test is never going to be more than the earlier one. So he's going to be at $125,000 deduction. Example 3, now this time we have service business, and he's below the threshold. So Carl, he's married, 50% owner in a bookkeeping firm, $100,000 of net income. He and his wife have $90,000 of other income, and they take a standard deduction of $24,000. So he's got $100,000 of business income, $90,000 of other income, $24,000 standard deduction. His taxable income is $166,000. That's a lot more than the $100,000, so we know we don't have to worry about that restriction. And he's just going to get his 20% of his $100,000. He's going to get a $20,000 deduction. Sorry for all these examples. I know they're not the most exciting thing, but I think they are helpful. So example number 4. we're going to do S corporation shareholder in a service business, income above the phase-out range. So you have Amy, she's married, 33% owner in a dental clinic, $550,000 of pass-through income. They have $250,000 of other income, and they're just taking a standard deduction. So net business income $550, it's service business. Other income $250, they're at $800. Standard deductions $24, so they're at taxable income of $776, and since they're a service business, they get no deduction whatsoever. All right, let's do a real estate example. So now we have a partner and a partnership involved in real estate, and their income is below the phase-out range. So Sarah's married, 25% partner in Blackacre, a real estate partnership. $250,000 of pass-through net business income. Her and her husband have $30,000 of other income, and they're going to take a $24,000 standard deduction. So we have $250,000 of net business income, $30,000 of other income. That's $280 minus the $24. We're at $256. The $256 is more than the $250, so we know we don't have a adjusted gross income or taxable income limit. So they're going to get, they're not in a service business of any type. So they're going to get they're going to get the full $50,000 deduction. Partner in a partnership involved in rental real estate. Now this one's going to get complicated because you've got we're going to have to rely on the asset test. So Paul is married, 50% partner in Greenacre. He has $750 of pass-through net business income. He and his wife have $100,000 of other income and $50,000 of itemized deductions. And Greenacre has $120,000 of W-2 wages and $4 million is the unadjusted cost basis of their assets. Now you got to keep in mind, we have the $4 million is the total unadjusted cost basis of the assets. Paul is only a 50% partner, so he only gets to count $2 million of that. But let's go through the math. So we've got $750,000 of net business income, $100,000 other income, adjusted gross $850. It's going to be itemized deductions of $50, so they're down to $800,000. The $800 is more than $750. So on the face of it, we know we could get up to 20% of $750, which is $150,000. But because they're above the threshold, we got to do the next two tests. So W-2 wages were $120,000. Paul's share of that is $60 because he's a 50% owner. So you do 25% of 60, what is that, like $15,000? But then the 50%, I'm sorry, the 50% of wages is 120 times 50% times 50%, so that's $30,000. But then we get to do the second part of the test, which is really always going to be important for these real estate entities, where we only get to do 25% of wages, but that's okay because then we get to do 2.5% of his half of the unadjusted cost basis of the property. So you add those two together, you get to $65,000, and that's going to be his QBI deduction. All right, that's the end of our examples. Let's do polling question number 2. So to what extent do you currently do year-end tax planning? None, some, or a detailed analysis? And our CPE word is depreciation.
Walter, I think we should have some very good understanding of the mechanics after those examples. I'm curious, first off, do the listeners have access to the slides, to the presentation? Can they download them if they want to?
They certainly can, yes.
Okay, good. Let me ask you a couple of questions that maybe they're thinking of. First, since an S Corp qualified business income is reduced by the owner's salary, can't owners just stop taking salaries?
You know, one of the reasons I like having you ask questions is that you ask things unfettered by any knowledge of tax law. which is really good because.
Well, I know I'm here with a tax genius, so.
But it's really good because a lot of times you do raise issues that we don't think about because you have a more open mind about things. And it really is a good question. So let me just kind of put some numbers to your question so people can follow it. So let's say we have an S corp with $2 million of revenue, and they pay their owner $500,000. They pay their other employees $500,000. So they have $1 million profit, and they're not service. So their QBI deduction is $200,000, 20% of $1 million. So let's do what you suggest. Don't pay a salary to the owner. Now their profit's 1.5, and their QBI deduction is $300,000. So you have, with the stroke of a pen, increased their QBI deduction by $100,000. So that's good. Here's the problem with that. The IRS requires S corporation owners to take a reasonable salary. So you can't take no salary. But it's interesting if you think in the context of the exit planning work we do. So let's go back to my example. $2 million in revenue, the owner is paying himself $500,000. And like a lot of the clients we work with, they're smaller. This guy does everything. He's the CFO, he's the sales manager, he takes out the trash, he does everything. So $500,000 may very well be reasonable compensation for him. But the one thing we're always trying to tell business owners is you need to increase the transferable value of your company. So in a situation like I just described, while the company has a nice profit, it's not necessarily real attractive to a buyer because most of the value is tied up in that owner. So what we try to do is recommend that the business owner start delegating responsibilities, maybe hire a sales manager, stuff like that. So if he actually listens and takes those steps, he could legitimately reduce his reasonable comp because now he's not doing as much. To get to your point, you could maybe get to a point where you are virtually an absentee owner, and maybe your reasonable comp is close to zero. So your question wasn't as crazy as it first seemed, maybe. But it does raise a good point that even in situations, just existing clients, we should look at S corp salaries because maybe there might not have been a lot of thought given to them because they weren't that important before. But somebody may be taking a really large salary, and we can legitimately say, your reasonable comp is half of what you're taking, and it would make sense to reduce it just for the reason that you mentioned. So that was a good question.
Okay, so that was not a crazy question, and I trust this won't be either. If not taking a salary doesn't work, what about becoming an LLC where business owners cannot receive a salary?
That's a good point. So again, this is a very interesting question, and we're at a little bit of a loss because I think there's going to be some regulations that are going to come up and kind of nix this idea. But at least for right now, let me just kind of articulate what you're saying. So as an S corp, you have to take a reasonable salary, which is automatically going to reduce your qualified business income and reduce your QBI deduction. LLCs and sole proprietorships and partnerships, there is no such thing as salary. They're not allowed to take a salary. So automatically, their QBI is going to be higher. If you have the exact same business, the exact same revenue numbers and expense numbers, an S corp is always going to have less QBI than a LLC because of the reasonable salary requirement. So on the face of it, that's a great idea. And I think certainly new businesses starting up, I think an LLC is probably going to make the most sense. But here's the issue. I doubt if one of the intents of the new law was to make S corps all switch to LLCs. So my guess is, and the House bill talked about this a little bit, I think they're going to have, their House proposal, I think they're going to have to come up with a way to kind of classify some of the LLC income as just regular compensation. So it's really going to be interesting because, reasonable comp has no bearing whatsoever. It's not even a concept for partnerships and sole proprietorships because reasonable comp was put in place to prevent C corporations from paying out dividend income and from S corporations avoiding payroll taxes. So it's really interesting that they're going to have to come up with regulations that are possibly going to introduce the whole concept of reasonable comp in some sense to partnerships and sole proprietorships. So it'll be really interesting to see what they do. But for now, LLCs do have that advantage.
Okay, so what other planning strategies can you share with the listeners to maximize the deduction?
Well, you know, I think as the flow chart showed and hopefully our examples demonstrated, if you're in a situation where your taxable income is below the thresholds, there's really nothing you need to do. You're going to get your full 20% deduction no matter what type of business you are, and that's great. If you are a specified service business and your income is way above the thresholds, then again, really not much planning to do because you're just out of luck. You're not getting any deduction at all. So where the planning is going to come into place is for those companies that year after year are near the thresholds, or companies who, you know, one year they do really well, one year they don't do so well. So those are the ones where planning is going to be really important, and you can kind of understand the reason for that. Let's say you have a business and the taxable income of the owner is 4,075. So they're right at the limitation. If they could do something like, let's say, and they've pretty much paid out all their expenses, they've deferred whatever income they can defer, and they're right at that threshold. And one thing they could do is they could maybe look at their current retirement plan. Maybe they have a SEP IRA, which isn't giving them the maximum deduction. They could convert to a defined benefit plan, which would give them a big deduction and may drop their income below those thresholds so they at least get a partial 20% deduction. And then the savings on that deduction would help to pay for that defined benefit plan. Another thing would be, we talked about with the rental property, you know, reducing the debt load. That's going to increase your qualified business income. If you're in a situation, this is kind of the opposite of the way we do tax planning now, but let's take an example where you're not a service business and your business is kind of up and down year to year. And you know you're in a situation where your income this year is, let's just say, $1 million, which is, you know, unbelievably high for you. And you figure next year you'll be lucky to make $300,000. But this year you got $1 million of income. So there's no way you're going to take advantage, and you're a service business. So there's no way you're going to take advantage of any thresholds this year. So an argument could be made that if you have the ability to accelerate income, you would do that. And if you could defer deductions, you would do that. So that's the opposite of what we usually, you know, the general rule is you defer income and accelerate deductions. Now we're going to be in a situation where it might make more sense to bring income into a year where you know you're over the threshold already, because that's going to set you up for maybe being under the threshold next year. Same thing with deductions. Push the deductions into a year where you have a shot at being under the threshold. So it's kind of the opposite of what we do normally, but in certain situations, it may be the better strategy. Another strategy could be, if you're over the threshold, but you're not personal service, you're not a service business, so you know you're going to be entitled to something, but you know you got to take that phase 2 of the test, which is based on wages. And maybe you don't have a lot of wages because traditionally you've used contractors. Well, maybe it's going to make sense to turn contractors into employees or hire employees to do what contractors currently do. Now, there's lots of reasons why that might not make sense, but strictly from our discussion here regarding the 20% deduction, having more salaries as opposed to contractors could be a beneficial move. Another area where we have some control over the amount of deduction or income is in the area of depreciation. So, you know, maybe, you know, a lot of times you buy equipment, you can either take bonus depreciation to write it all off, or you can take Section 179 and write it all off. Maybe you don't want to do that. If you're over the threshold, maybe you don't do that. So do you preserve some of your depreciation deductions for future years when maybe you can get under the threshold? So it's all, the bottom line is, it's all very interesting because it's, you know, it kind of flips around some of the traditional planning that we're used to doing. And also keep in mind that because the phase-out limits are based on the taxable income on the individual return, there might be things you can do on your individual return to reduce your taxable income. So let's say you've gotten your qualified business income down as low as you possibly can. Well, then you can look at your individual return. And again, it might be a situation where bunching your charitable contributions together might give you a big deduction and get you below the threshold. So there's definitely planning that can be done, and it's going to kind of take a new, it might be kind of different than what we're used to doing, but it's it can be very very interesting, and I think it's well worth doing, as we've talked about.
Are there other business rules that have changed under the law?
Yeah, let's spend a few minutes kind of going through some of these. So depreciation has had some pretty big changes. So we have bonus depreciation, which now has been expanded to include used property. And you can see the percentages there. So up until 2022, you can actually write something off with 100% bonus depreciation. So that's a good deal. The other, you know, deduction most people are familiar with when it comes to property is the Section 179 cost recovery deduction, which under old law, you could deduct up to $500,000 of property, and that phased out once you put over $2 million into service. The new rules are $1 million, and the phase out starts at $2.5 million, and that applies to new and used property. So those are some pretty big changes, but probably the biggest change in regard to Section 179 is the second part of this slide, which improvements to non-residential real property are now considered Section 179 property. So if you replace your roof, you can read it, your roof, heating, ventilation, alarm systems, security systems, those things can actually be written off under Section 179 now. So this is going to alleviate the issue where, you know, a client has a rental property, they come in, they've done a lot of work on their roof, but they didn't really replace it. So then it's a matter of, well, is it an improvement because it's virtually been replaced, or can we treat it as a repair and get to deduct it? Don't really need to worry about that anymore because we can take it under Section 179. So that is that's a pretty big deal there. And then another change, which maybe isn't as big, but it's still important, is they changed the like-kind exchange rule. So it used to be you could do like-kind exchanges for a lot of things. You could exchange real estate, you could change artwork, you could exchange animals. I mean, lots of different things. What the new bill does is it says, going forward, the only like-kind exchanges are real property. So, I mean, those have always been, at least in our world, the most important types of exchanges, and they're still allowed. So that's kind of the good news of that one. There are some new loss rules that, you know, didn't get a lot of coverage. People may not be fully aware of them, but, you know, basically the IRS has, in Congress, they've set up rules to kind of limit your losses. They try to limit it so that it kind of reflects the economic reality of the situation. So, for instance, you know, the first general rule is you can only deduct a loss up to the amount of money that you've put into an investment. Then the second one says, well, okay, we'll give you the money you put in, plus if you're liable for some debt that is being secured by the property in the business, we'll let you deduct losses up to the extent that you're at risk for that debt also. Then, like I mentioned back in '86, they put in the passive loss rules, which basically put all these restrictions on your ability to deduct your losses unless you're actively participating in the business. And now they added a new provision, which basically says your active business loss is now limited to $500,000. So if you have $1 million loss, you're only going to get to deduct $500 in the current year. So kind of the way this works, under, it says current law, I would call it old law, it was $2 million of other income, $750 business loss, so your net income was $1,250,000. Now, $2 million, you still have that same $750 loss, but you can only deduct $500. So you're paying tax on $1.5 million, and you're carrying forward the extra $250. So that's kind of a sneaky little provision they put in there. Then NOL deductions, and these, I think this actually is an improvement to the NOLs, but Under current law, NOLs can generally be carried forward 20 years and back 2. What the legislation does, and they offset 100% of your income. What the current legislation does is it limits the NOL carryover deduction to just offsetting 80% of your taxable income. It eliminates the carrybacks, but it makes you can carry forward indefinitely. So that part's good. Not being able to carry back hurts some, but that's probably okay. But I think the more important thing, and a lot of people may not realize it, but limiting the NOL to only 80% of taxable income is probably a benefit. Because if you think about it, if you carry an NOL back and you wipe out 100% of your income, that means you're wiping out income that would have been subject to a very, very low tax rate, maybe 10%, 5%, something like that. So you're not getting as big of a bang for your NOL if you can offset 100% of income. By only being able to offset 80%, you're going to be offsetting only income that is subject to a slightly higher rate of tax. So while you won't get necessarily as big a bang in 1 year, I think over the life of your NOL, you're actually going to come out ahead. So let's go ahead and do the final polling question. Oh, wait a minute, we have a few other business deduction changes. So these are important too. So we have entertainment expenses are now completely disallowed, but this does not include meals. You always talk about meals and entertainment, but they are actually two different things. They were always lumped together in the past because they were both subject to 50% deduction limit, and meals are still subject to, they're only deductible 50%. But entertainment expenses, which are things like you take a client or a prospect to a ball game or a concert or something like that, that's entertainment, and that is now 100% disallowed. But meals are still 50% allowed. Parking and mass transit deductions, that's where you pay for your employee to get the Metro card or whatever, or you pay for their parking. Those deductions are now, or those payments are now not deductible by the company, but the employee is still allowed to exclude them from income. So they're still tax-free to the employee, but now the company is no longer going to receive a deduction for them. Bicycle commuting exclusion is suspended. I didn't even know that existed, but I guess I didn't need to know it existed because now it's gone. So anyway, and then moving expense reimbursement exclusion. Remember when we were talking, if you were here for the individual part, we talked about the moving expense deduction no longer exists except for certain military people. And the moving expense reimbursement exclusion also no longer exists except for certain military people. So that's kind of the rule there. I don't think, there are some other, since we only had an hour, we didn't want to get into some of the really complicated provisions that affect very few people, like change in accounting methods and stuff like that. But if that is an issue for you, please feel free to contact us. And if you're an existing client, we're going to be looking at all that stuff for you automatically. So let's go ahead and take our final polling question. So the question is, to what extent have you begun planning for the exit from your business? Not yet thinking about it, thought about it some, have some ideas but not a formal plan, or I have a current written plan. And our CPE word is losses. Okay, let's, can you bring questions up? Let's go ahead and do some questions. So, Pat, before we go to the questions, what's your takeaway from all this as it relates to the work you do?
Yeah, well, I think the listeners would agree with me, Walter. This has been very helpful. Certainly a lot of complications and planning opportunities are now in play that didn't exist before this tax law change. As it pertains to the exit planning work that we do and helping owners build value in planning and exit, I think it's like this, as we often say, if you wait until you're ready to exit to begin planning, you won't be ready, and neither will your business. Well, it seems like the same thing applies here to tax planning, doesn't it? You have to be proactive and get ahead of the curve, and if you do, you'll be well positioned. If you don't, you could get some surprises and get hurt.
Yeah, I agree. And I think, we've always said that about exit planning, and it's really, It's always been true about tax planning too, but I think under the new rules, it kind of takes on a new level of importance. So thanks for that. Let's go ahead and answer. Let's go ahead and answer some questions. Let me just see what we got. So here's an interesting one. So what is better, Section 179 or bonus depreciation? So you're supposed to answer every tax question with the answer it depends. But while that is true, I can kind of give you some guidelines. So in a lot of ways, it seems like they're kind of the same. But bonus, generally speaking, I would say is probably better. And here's some of the reasons why. Section 179, as we discussed, has dollar limits. Bonus depreciation doesn't have any. Section 179 has recapture rules. If you convert, like let's say you have your personal auto and you took Section 179 and you convert that to personal use, there's recapture rules that bonus depreciation doesn't. Section 179 is limited to the amount of business income. Bonus depreciation isn't. Probably the one advantage of bonus depreciation is if you want to elect out a bonus depreciation, you have to elect out for the entire class. So if you can't just, whereas Section 179, you can go asset by asset to elect out. So I think generally speaking, bonus is probably better. I have a couple questions that I'm going to just kind of summarize, because what they're basically asking is, if you've got a company that maybe has components of specified service as well as components that aren't specified service, what do you do? Is there some strategy, and what's the situation with that? So let me think of an example. Okay, so here's an example. Let's say you're an eye doctor. So clearly you're a health professional, but you also sell glasses and frames and things like that. I think under the existing rules, the way it would work is it would be kind of, you'd look at it and you'd say, okay, well, is the sale of glasses just kind of a sideline to the main business of providing health services, which could get you into trouble. So probably in a situation like that, it may make sense to separate the two businesses. And that does, just you could set up a separate LLC for the business that's actually selling a product, and then that business would qualify for the QBI deduction, while the healthcare part obviously wouldn't, unless you meet the phase-out rules. Someone's asking, you've mentioned a couple times that we're in limbo until we have regulations. When do you think those will come out? Well, that's a really hard question. Like I mentioned, the rules on personal service companies are still in temporary status. But the 1986 Tax Act was passed in October of '86. The first thing they did was a Technical Corrections Act, which came out in April of '87. But with the Technical Corrections Act, that actually has, that's an act. It actually be voted upon. So the '86 Tax Act was very bipartisan. There were very few people who voted against it. So getting a Technical Corrections Act through Congress was a simple matter. Getting a Technical Corrections Act through this Congress is definitely not going to be a simple matter. So you may not even see a Technical Corrections Act for this bill. Regulations, it's pretty much impossible to say when they are going to come out. I mean, they'll certainly start coming out with some proposed regulations in the more important areas, which I think one of the first ones may be dealing with the disadvantage of S-corps versus partnerships and the way compensation is treated. And there is some background on that. They've tried a couple times with the self-employment tax rules to try to put some compensation calculations into the LLCs, but they didn't get too far and got a lot of pushback. So it'll be interesting to see how that one goes. But I wouldn't look for regulations anytime in the near future. Maybe in the summer, or probably much later than that. Here's a question that someone's saying. So if you're a sole proprietor and you have a Schedule C, do you get the 20% deduction? I thought this was just for pass-through businesses. So it's kind of, I'm not sure why they named it the pass-through business rules, because, yeah, you clearly get it as a sole proprietor. So just consider your sole proprietorship to be a pass-through, and you qualify for everything that a pass-through does. Someone's saying, has anything changed regarding what is permissible as business expenses to get to net business income, other than where I mentioned the transit benefits and the entertainment. All the other deductions are pretty much the same, or are the same. If you're a very large company with over 25 million in revenue, there may be a restriction on your ability to deduct business interest, but I didn't go into that because it's complicated and probably doesn't really apply to many people. For a sole proprietor, does the 20% pass-through deduction impact how much can be contributed to their 401k? That's a good question. So the 20% deduction, the way it's going to show up on your tax return, it's going to show up after itemized deductions as just another subtraction from income to arrive at taxable income. So it's not going to affect your business income, so it is not going to have any effect on the amount that you can put into your 401k. Someone's saying, does passive activity loss limitation have effect on pass-throughs? Yeah, definitely. So the passive loss rules have not changed, but keep in mind they apply to losses, whereas the 20%, new 20% QBI deduction applies to income. Question, actually from a client who is an attorney, C Corp, who liked the idea that I didn't like of accumulating earnings in his C Corp. So I can go into that a little bit for him. And again, the rules that work against this are very, very old and have not been in play for probably over 20 years, so I'm not fully up to speed on them. But in general, you got two sets of rules. One is personal holding company rules. And what they basically say is, and these probably aren't going to apply, because what they basically say is if at some point your personal holding company income exceeds a percentage of your other income, then the personal holding company rules kick in. And personal holding company income is like investment income. So you'd have to have a lot of investment income before that one would kick in. The one that may kick in would be the accumulated earnings tax. And what they do with the accumulated earnings tax is they assess an additional 20% tax on the amount that they consider to be accumulated, excess accumulated earnings. And where this one could maybe get people, and again, who knows how aggressive the IRS is going to be on this. They haven't had to really worry about it for many years. But the general rule is that if you're accumulating earnings for anything other than a legitimate business reason, then you have excess accumulated, you could have excess accumulated earnings. Now, normally the kind of the out is you can always say, well, we may want to acquire somebody someday. And then you can pretty much accumulate whatever you want. And maybe you could do that as a law firm. I'm not sure. But the troubling wording is that they do specifically say if you're accumulating earnings to make investments that are not directly related to your business, then those are considered excess accumulated earnings. So if all you're doing is retaining your earnings and putting it into an investment account, they could attack you under that rule. Like I said, I'm not sure how much they would. And again, even without that, I'm still not sure it makes sense to do. But it's it's a case-by-case thing, and we can certainly look at. Let's see. So professional service corporation, you want to take health insurance premiums and other benefits to decrease taxable income. How about also paying higher salary to owner? So I'm not sure that really helps. Like, if you're way over the threshold and you're a service corporation, so you pay yourself a big salary, you're going to pay ordinary tax on that. That gets you below the threshold. But see, the problem is you're reducing your qualified business income, but you're not reducing your income, your taxable income. So while you're reducing qualified business income, you're doing nothing to get you underneath the threshold, because the threshold is taxable income. So even though your qualified business income goes down, your W-2 goes up. So you're right in the same place you were originally. Let me see what else. Okay. Here's a question about the adjusted basis of assets. And I thought I covered this, but maybe I covered it earlier. If you have assets that you put into service a couple of years ago and you have fully depreciated them, you can still count them as unadjusted basis of assets, because the way it works is you're allowed to continue to count the cost of assets as long as they're still in service for the longer of 10 years or their depreciable life. So if you have like a computer that only has a 5-year life and you've already written it off anyway, you get to carry that into this calculation for 10 years from the day you buy it. So hopefully that clears that up. If you have a piece of real estate, the life on that, if it's commercial real estate, is 39 years. So it's a long time. Here's a question, and I apologize, I probably should have covered this, but they're saying, don't employers now have to offer paid family and medical leave? And I understand where that question is coming from, because the answer to that is no. There is no requirement to provide that. But the reason that question is coming up is because there is now a new tax credit if you pay family and medical leave. The credit is equal to 25% of the wages paid for up to 12 weeks. An eligible employee can't make more than $48,000, so it's pretty much geared towards your lower income employees. So that's a good question, but no, there is no requirement to provide it. But if you do, you're going to get a tax credit. Let me just see what else we have. Since they got rid of personal exemptions, are they going to redesign the Form W-4 for withholding rates? Yeah, they're going to have to. I'm not sure when they plan on doing that, but yeah, they're going to have to do that. Let me just see what other questions we have. Started my business in 2017 and put it into service equipment I had purchased in prior years. No, it's not considered used equipment if it just went from you to you. It has to be, it's okay to purchase it from someone else, but you can't, it's not used equipment if it's just your equipment already. Let's see. Why do you think they took the deduction away from a service business? Well, I think the emphasis was on trying to give benefits to companies that actually produce things, which I thought, on the face of it, is a little unfair because service businesses pay a lot of salaries. We employ a lot of people, and the salaries are good salaries. So I thought it was kind of unfair not to include personal service businesses, but I think that was the reason, is that they're trying to benefit businesses that actually make things. Let me just see what else we have. Okay, so here's one. What's considered a consultant? I have several different occupations under my partnership. Do I change my type of service? I have Airbnb and vacation rentals and other things. Yeah, if you have, there's really no definition of consultant. It's just going to be a facts, and it's going to be based on the facts and circumstances specific to you. But to the extent that you have business lines that clearly are not service businesses, you would want to segregate those so that there's no possibility of tainting those with the service operation. So at this point, I think we are done. So just like to thank everybody for attending today's webinar. Hopefully you found it helpful. Pat, thanks again for joining in. Steve, you too, thank you very much. We encourage you to join us for one or both of our next two events. We're continuing our Baltimore seminar series in 2018 with an event on the morning of January 25th. It's called the Top 10 IT Risks Targeting Your Nonprofit Is Your Sensitive Data at Risk. There'll be an invitation coming out, so you can join us at the Center Club in Baltimore or online via WebEx. As we mentioned before, we're also holding part 3 of this series on the new tax law with a look at tax-exempt organizations on February 15th. And you can check our website for updates. We're at www.grfcpa.com/resources/events. And if you have any other questions regarding your own situation, please reach out to any of us. I was going to put Steve's cell phone and home number on here, but he wouldn't let me. But feel free to contact the office. And if you're a regular client, obviously we're backed up with the new tax law and the number of clients we have, but we are working through clients methodically to figure out what strategies are going to make the most sense for you. But feel free to contact us. And if you're not a client, we look forward to speaking to you as well. So thank you very much, and we look forward to doing this again sometime.